Hi, it's Kim Butler. I'm so excited to have you included in this learning that we're going to do about the 7 principles of prosperity. So the first one that you can see there is the word think, because we need to be turning our brains on. We want to be operating from a positive mindset. We want to be thinking prosperously. Now, do I do this every day? No. There are sometimes numerous times within a day that I will catch myself in scarcity thinking mode. I'm fearful. I'm concerned. I think there's not enough of whatever it is. And I work hard to catch myself, because if we are thinking from a scarcity mindset, we will make different decisions than if we are thinking from a prosperous mindset. So it's just a good reminder to just alert yourself and try to do whatever you can to think prosperously as often as you can about as many things as you can. And if you find that you can't, stop and go do something else, like go pet the dog or go outside or do jumping jacks or something to shift your physical body, because sometimes that actually helps, and that can shift your brain so that you can get into thinking from a prosperous standpoint. The second principle then is to see, and you'll notice the word is SEE. We want you to see the big picture of your finances. And this is actually a tricky thing to do, because it's really, really easy to get very vacuum oriented in a particular decision. And we're just narrowing it down to this one little thing. And we're looking at it, maybe an investment decision, for example, in a vacuum, unrelated to all of our other finances. And that is not a good way to make financial decisions. You want to see your entire perspective. You want to see all your assets, all your liabilities, your income streams, your expenses, your protection component like life insurance and wills and trusts and LLCs and all those other things that protect our assets. So do what you can to see things from the big picture, even if it's like sketching it all out on a yellow pad or using some type of mind map on a computer. I know a lot of people have their personal finances on Excel spreadsheets. Great if that works for you, but I find that in that manner, it's hard to see the big picture. All right. Number 3 is measure. Now, we're talking about finances, right? So this seems kind of obvious, but it's important to understand that we're actually introducing a concept here called opportunity cost. And that is an economic concept that is not always brought down to our personal finances. You want to have your opportunity cost clear. And what opportunity cost is measured by is the rate of return that your best investment makes. So if that's 5% or 10%, and you spend money on something that you're not going to get back, then not only have you lost the money, you've lost the opportunity to invest that money for the rest of your life. So there are areas around the protection component, like life insurance and car insurance and home insurance, where we need to be careful to not have opportunity costs be eroding a big portion of our wealth. There are other things that people do sometimes that cause opportunity costs. So I'm just introducing the idea, just helping you be aware of it, that you want to measure your opportunity costs. And then, of course, we'll do what we can to help you reduce them. The fourth principle is flow, and this is indicative of money coming in and going out, and it's primarily cash flow. It is interesting how most finance people measure progress around net worth, and net worth is frankly just an interesting number, a fun fact, if you will, because what really drives your life is cash flow, money in and money out. So we want to be looking at our cash flow, figuring out what we can do with it, how we can improve it, etc. Number 5 then is control. We want to put you in control of our money. We want to be in control of our money. You want to be in control of your money. And there are way too many things that we do that give up control. We prepay mortgages, puts the control in the bank. We put a bunch of money in 401k plans, puts control in the government. We do things like 529 plans and annuities and other products where we turn control over to the financial institution. As a general rule, try not to do that. Try to look at all of your assets and put as many of them in your control as possible. Number 6 then is move. We want to keep our money moving. Money that's static is like water that gets in a river that kind of slinks over to an eddy and just sits there and gets yucky. Dollars need to be moving through assets and not just to them. So like my earlier examples, If you are out of control, it's typically because you're not moving money. If you are putting in places where you can't move money, you typically are also not in control. So all the principles are actually interrelated, but those ideas where you can move money through them. So as an example with life insurance, real estate, those things, you put money in them, you can borrow against them, move it back out, go do something else. Those are a good example of assets that you can move money through. And then that brings us to the seventh principle, which is the last one. When you multiply results, it is typically because you're moving money. When you're moving money through assets, then you are multiplying results because you're getting dollars to do many, many things as they go through the various assets and sometimes through the protection components as well. So bringing up the life insurance and the real estate as a sample again, you build up your life insurance, that's your emergency opportunity fund for your real estate. You borrow against it, make a down payment on a deal, use the real estate income, investment real estate, to pay back the life insurance loan, keep the money moving. Now you get both the life insurance cash value growing and the real estate growing, and you have the opportunity to utilize the death benefit at the end through charitable remainder trusts, reverse mortgages, etc. So that's an example of the multiplier effect of what happens when you focus on cash flow, maintain control, get your dollars to move, and then they multiply. I just wanted to give you an audio to go with the little puzzle that you're working on to learn about life insurance. And as you can see, there's video too as well, if you like. So the first definition on all the words about life insurance that we want to learn is the premium. And it's really easy to get caught up in our usual definition of premium, which is what we think about with car and home insurance, and premium equals cost. However, with whole life insurance, premium equals cash value. So once you get past the first couple of years, your premium will build cash value. And that's definition letter A. B is the guaranteed portion of the cash value growth. So cash value grows guaranteed. It is an actual dollar figure that grows. It is often expressed as an interest rate, but it is an actual dollar figure. And there is a guaranteed growth of your cash value. Now, C is that there are dividends added to that guaranteed growth as long as your dividend election is to purchase paid up additions. So paid up additions, kind of a weird word, but it's an important one because it actually builds more cash value, and that's what most people are wanting. It also builds more death benefit. So dividends are something that we want to learn about, and they are different coming from a mutual life insurance company than when they come from like a public stock company, primarily because they've been paid every single year, well over 100 years, from all the top mutual life insurance companies. C then is dividends. Now D is gross cash value. Now this is an interesting term because some insurance companies call it net cash value, which I know is confusing, but the gross cash value in our discussion today is actually your guaranteed cash value plus the dividends. It's really what you're going to be looking at most of the time. It's also the amount that you can borrow against. And so I believe it is more valuable to call it gross cash value so that you're really, really clear on it's that big number and it stays that big number no matter whether you've borrowed against it or not. E then is automatic paid up additions. Now the terms automatic and manual are mine. Most insurance companies don't use them, but I think they're very helpful. So automatic paid up additions are what your dividends buy. F is manual paid up additions, which are what you add so that you get a chance to add to your cash value by adding extra money in the form of a manual paid up addition. G then is waiver of premium. Now, not everybody gets approved for this. It is a rider that gets added, but it's an important one to remember, and it does pay the premium. And again, remember, premium builds cash value, whether you're disabled or maybe have some kind of severe illness. So there's a specific definition of disability, and the premium gets paid if that disability occurs, and it can pay until you're age 65 if you're disabled that long. G is waiver of premium. All right, then H is the death benefit. Sometimes it's also called the face amount. So these terms are interchangeable. We tend to use the word death benefit. And this is the amount that pays when somebody dies. So if the insurance is on you, then when you die, it will pay. It might be on a adult child, and then it would die when they pay, ideally to the next generation. Then H is death benefit. That's the one that is that larger amount. It is income tax free, a good one to remember. I is increasing death benefit. And this is one of the hardest things for people to remember. And I find there's a lot of misinformation about it out on the internet. And that is that the death benefit of whole life does increase. And it must increase in order for your cash value to stay tax deferred. So your death benefit growing does mean that upon death, your family will get the original death benefit as well as the bulk of the cash value. So real quick numerical example, if you have $1 million death benefit and you are going to grow your cash value and over time it's say $200,000, your family's going to get fairly close to that $1.2 million number. Now, obviously the insurance company has to make a profit, so the numbers are not exact all the time, but it is untrue that with dividend paying whole life insurance that you don't get both the death benefit and the cash value, because that death benefit is growing all the time. So I, increasing death benefit. J then is the interest that is on your borrowed cash value. So your cash value, when it is collateralized or borrowed against, does earn the dividends without a doubt. It doesn't matter whether it's direct recognition company or non-direct. That's something that is, again, a lot of incorrect information on the internet. It earns dividends regardless of whether it's borrowed against. And when you borrow against your cash value, notice the language, borrowed against, not take out or not take from or not borrowed from. Those are all incorrect terms. Now, you can take it out. You can take out your cash value, but that's a different discussion. So when you borrow against your cash value, you are charged interest from the insurance company. So J is the interest that the insurance company charges. Now, as of this recording, cash value grows probably 4.5%. Interest is charged variable at 5 or 6, fixed at 7 or 8. Those are not the things that you should compare though. You compare your cash value growth against the account that would be liquid, like a checking account or a savings account, probably 2% taxable, by the way. You compare your loan interest charge to what else you could do if you needed to borrow money. So is it a credit card at 16 or 18%? Is it a loan, for your home equity line and it's at 2%? Well, then great, go borrow against your home equity line. So you have to pay attention to the interest. Again, this is J, that gets charged on the borrowed cash value from the life insurance company that you pay back to the life insurance company. Now, you are an owner of that life insurance company because it's a mutual life insurance company. All the policy holders are owners. So I can see why people on the internet say that you pay yourself interest, but that's technically not accurate. What you get instead is that growth of cash value unaffected by the loan. All right, so that's J. K then is the owner. So there's an owner of the policy, and I want to bring in L, which is the insured, because the owner is who takes out the policy, who controls the policy, who typically pays for the policy, who can borrow against the policy. The insured, again, which is L, is the person that the insurance is on. And so you have the owner and you have the insured. Sometimes those are the same people, but not always. So I own insurance on myself. I'm the owner and I'm the insured. I also own insurance on key employees. I'm the owner. The key employee is the insured. I also own it on my adult children. They are the insured. All right. M then is the automatic premium loan. So just like you can borrow against your cash value to do a real estate deal or to solve an emergency, you can borrow against your cash value to pay a premium. And it's actually done internally at the insurance company. It's called APL, Automatic Premium Loan. Not something that you want to do a lot, but certainly doable if that is what needs to happen in order to keep that policy in force. N then is a reduced paid up policy, RPU. Now this is what happens when you have maybe just completely run out of resources, completely run out of money, or you're at a place where you just really don't think the death benefit is valuable anymore, and you want to reduce the amount of the death benefit, and you want to pay up the policy, reduced paid up. Pay up means that no more premiums are required or available, meaning you cannot contribute to it again. I consider this kind of a worst case scenario and not something that you would want to do, but it is there. It's nice to know it's there because we go into obligations and opportunities like this knowing that we're supposed to keep them our whole life, but understanding that that's not always possible. So RPU, letter N, is a nice strategy to know about. Worst case scenario, it's out there. You can do that as early as the second or third year. Again, not what I would recommend at all. As late as the 30th, 40th, 50th year. All right. O then is opportunity cost. And this is a concept from economics that needs to be brought in, a part of the whole life discussion and all these definitions that we're learning about, because the whole life product eliminates opportunity cost that is elsewhere in your financial life. So what's opportunity cost? Well, anytime you spend money on something that you're not going to get back in most cases, not only do you lose the money that you spent, but you lose the opportunity to do anything else with that money. And a really good example is term insurance, because most people do not die within the term of time that the term insurance exists, 1 year or 15 years or 30 years or whatever the time frame is. Their premiums have an opportunity cost associated with them. So you have your premium and then you have an opportunity cost that is what you could have done with that money had you not used it. Now, please be clear. I love term insurance. I write a lot of it. I help people buy it. It is a very valuable thing to have. And it's something that you want to have in force to get up to your human life value. And you need to be clear, it's probably not ever going to pay. In fact, the statistics say it's like 0.5% ever pay. So you want to go forward knowing that the term insurance is there for a term of time. The whole life is there for the rest of your life. And because of that, you don't have opportunity costs. Now, just quickly so you'll know, the way you calculate opportunity cost is you put an interest rate on it. So you take a look at your best investment. Let's say it's 5%, could be 10%, whatever you think your best investment is. That's the interest rate at which you calculate opportunity cost. So you have a dollar figure that goes for whatever you're talking about, and it's at 5% for the rest of your life, because opportunity cost doesn't ever really stop. So this is true of, I mean, you don't want to go extreme, like it's not true of food and things that benefit ourselves, but anytime we're spending money that we're not ever going to get back and that we got no benefit from, then there's opportunity costs. Now, again, with term insurance, there's a peace of mind benefit. There's a value to our family knowing that we're covered if we die. So I don't want to have you misunderstand that. Nevertheless, opportunity cost is an important thing to remember. And it's nice to know that with whole life, there is none, because even though in the first few years, the value is not the same as what you've put in, that it has a guaranteed payment and a guaranteed growth, so that will rectify itself. Usually break even is around the second or third year, sometimes fourth year for older people on an annual basis. And break even is around the 7th, 8th, 9th year for older people, again, on a cumulative basis. So that's another thing that I think people are always curious about learning. So thanks for joining me with this commentary on the items that are available for you to learn about life insurance so that you too can take advantage of it for you and your family.